So you're feeling like a mother hen sitting on your retirement nest egg, making sure that nothing unexpected will happen. Let's talk about how to assess if stocks are too risky as you hatch your retirement. Hey there, welcome back to my channel. It is another Pleasant Financial Conversations day where I interview someone else from the industry to talk about something that's relevant for my clients. And today I'm going to be talking to Chip Gordy. He is a chartered retirement planning counselor from Maryland and has been in the industry for over 20 years. Something that Chip and I both share is a common client who is nearing retirement and asks the question, are stocks too risky for me right now? And that's what we want to answer in today's conversation. But before we get into that, don't forget to subscribe to this channel for a regular Pleasant Financial Conversation. And for you ladies, jump over to my online community, Pleasant Financial Conversations, over on Facebook, where we talk about all things money and investing. And you can ask any question that you have, I'll answer it. I'll see you there. Chip, so good to have you on Pleasant Financial Conversations. I know we both work with retirees and people nearing retirement, and a common question I receive, and after talking with you, you receive too, is the person nearing retirement that is asking, should I still be in stocks? Or should I back off now that I'm stepping into retirement? So tell me how you answer that question.
Well, when a client usually talks about this or brings it up at a meeting, it's because they've heard it in the news and all the bad things are happening in our economy and the stock market, or their neighbor had a bad experience with investing, maybe into one stock or the stock of the day. First, I take a look at the options. If not stocks, what's next? Well, you have bonds. That's basically when you're lending money to the government. If it's a government bond or a corporate bond, a corporation, you don't really make much interest with that. And unfortunately, in this low interest rate environment, you're not even going to come close to the inflation rate, which right now is about 2.5%. They can put the money in the bank, which is very liquid. They can get to it quickly if they want, but they're not even earning as much as a corporate bond. So again, it's almost like dead money. The last place they can put the money, if it's not a stock or a bond, they're just going to keep cold hard cash. They could stick it under their mattress or put it in a coffee can and bury it in their backyard.
So it sounds like in the short term, it's not always cut and dry. When we're comparing our options, there's not a clear-cut answer, especially because interest rates are so low. And so when our clients are making this decision, they've hired us to not only look at the short-term time, but also 20 years past retirement. And so how do you approach that?
Hard to look at ourselves, what life's going to be like 20 years from now. What cost you $1 20 years ago, today will cost you about $1.65. But I can tell you that stocks are really the only investment vehicle that I know of that really do a good job of outpacing inflation. And I always like to tell people investing is a lot like a yo-yo on an escalator. Okay, the yo-yo's going up and down, but the escalator's gradually going up. Okay, you got to stay on that escalator. Don't worry about the yo-yo.
Yo-yo on an escalator? I love that metaphor. I'm going to steal it from you. Thank you very much. In our office, we always ask the question, what do you think is going to be happening in 5 years? Do you think there's going to be trucks on the road hauling goods back and forth? Do you think companies are going to be offering goods and services? Do you think there's going to be construction? And if yes, well, stay invested in the stock market because it's comprised of all of those types of businesses. It's not just some pie in the sky thing. If no, well, that brings about a whole other conversation. But as I'm thinking about all of that, it brings up another highly relevant point, and that is, how do you actually invest in stocks? Because there is a difference, right?
Absolutely. That actually brings up a couple points. Usually a well-diversified portfolio of stocks is a lot safer than, a concentration in one or two stocks, because no one or two companies together is purely safe. And, low price penny stocks, because their share price is low, they're often affordable, but rarely provide a sustainable return. Also, I do want to mention that studies have shown over the years that you minimize your risk in the market by being invested by 95% by staying invested for 5 years, because volatility is here and it's here to stay.
So as you can see, it's not always easy as taking one risk and assessing whether or not you should do it based on your comfort level with it, because there are different risks that you take on when you take one risk off the table. And so that's why partnering with a financial advisor like Chip or myself is so important, because we help you make those incremental decisions towards retirement to really help you move the needle towards the bigger picture that you're trying to get to. Because it's not actually just about stocks. It's about your plans for retirement, your goals, the family dynamics, et cetera, and having that sounding board to bounce all of these ideas, fears off of, so that you can get the best financial setup is really what we're all about. All right, friends, that's all I have for today. Thank you so much for tuning in. I appreciate it as always. Chip, thanks so much for being on Pleasant Financial Conversations. It was a true pleasure to have you here today. And until next time, friends, you take care.